Let's talk about discount points and whether or not it's worth it to pay them to buy down your interest rate when purchasing a home. For those of you who aren't familiar with discount points, they are an optional fee you can pay your lender to get a lower interest rate than the lender's standard rate, or what's referred to as their par rate for the life of your home loan. The par rate is the interest rate your lender will give you without having to pay any additional points or fees for that rate. And when we say discount points, we're referring to a percentage of your home loan. For example, one discount point equals 1% of how much you're borrowing. If you're applying for a $400,000 home loan, one discount point would cost you $4,000. Let's take a look at a sample rate sheet to help make things a little clearer. For this example, we'll be using a loan amount of $400,000 and the par rate, or rate without any additional cost, is 6.25%. If we go up to the top, we can see that if you want to buy down your interest rate to 5.92%, it will cost you 0.85%, or you could also say 0.85 discount points, and that will add $3,384 to your closing cost. So when you pay discount points, you're essentially paying a higher fee upfront for your home loan so you can have a lower monthly mortgage payment for the life of your loan. Now, if we go to the bottom of the rate sheet, you can see that you can actually take a higher interest rate and receive a closing cost credit from the lender. So, for example, if you wanted to take a 6.5% interest rate instead of a 6.25% interest rate, the lender would actually give you $2,724 towards your closing cost. While taking a higher interest rate might not seem ideal, this is an option that can allow home buyers to buy a home when they don't have enough money saved to cover their closing cost. Okay, so now that we know what discount points are, is it worth it for most home buyers to pay them? To answer this question, it's helpful to take a second look at our previous example to see how the cost of paying discount points will affect your monthly mortgage payment, and also how long it'll take for those costs to pay for themselves. So, from our earlier example, if you're considering buying down your interest rate from 6.25% to 5.92% at a cost of 0.85 discount points on a $400,000 home loan, you'll save around $85 a month on your mortgage payment. Remember, the cost of 0.85 discount points works out to around $3,400, and we divide that number by our monthly savings of $85 a month to see that it will take around 40 months or 3.4 years until the cost of the discount points have been paid for. By the way, I'll put a link in the description section if you'd like to download a free copy of the discount points calculator to use for your unique home purchase scenario, and you don't have to provide any personal information to download it. Now that you know what discount points are and how to calculate how long it will take to pay them back, here are some things to consider when deciding if paying discount points makes the most sense for you. The first thing to consider is not all discount points are created equal. Some lenders offer more of an interest rate discount at a lower cost than other lenders, and these discount amounts can change significantly based on current demand and what's going on with the mortgage-backed securities market. So you always want to pay close attention to how the math works out for your specific home loan. The second thing to consider is the opportunity cost of paying for your discount points. For example, you could take the money you would have paid for your discount points and save it for your emergency fund. You could invest it in a no-fee index fund, or you could add that money to your down payment to reduce the amount that you are borrowing for your home loan. If you recall our earlier example with a home loan of $400,000 at a 6.25% interest rate, and instead of buying down your rate, you took the $3,400 cost of the discount points and added that to your down payment to reduce your loan amount to $396,600, you would actually save $20 a month on your mortgage payment and have more equity in your home. Finally, if interest rates come down significantly before your discount points are paid off and you end up refinancing your home loan, or if you plan on selling your home prior to that time frame, then paying for discount points aren't going to be the best option for you. As you can see, there are a lot of things to consider when deciding if paying for discount points makes sense for you, and that's why it's crucial to work with a lender who will take the time to walk through all the different scenarios with you and help you make the best decision that makes the most sense for your unique situation. If you have any questions about discount points, you can always reach out to me directly or leave them in the comments section. I answer every single comment I get, so thank you very much for those. If you'd like to learn about the 2-1 temporary interest rate buy down as a possible option for your home purchase, you can check out a quick video for that by clicking here. Thank you so much for watching, and I'll see you in the next video.